The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, this is Esther Gulius, the Tax Lady with Ask the Tax Lady, and I just want to wish everybody a wonderful kind of belated Thanksgiving weekend. And, this time of year, we do have a lot to be thankful for, even with the state of our country, everybody mad at each other. I'm thankful. I'm thankful for people like you. I'm thankful for Western New York. And I'm thankful for Tiffany Fabian, my daughter.
Hey there, Mom. How's it going?
And Christopher Fabian. And you want to call me Mom, too?
Hello,
Esther.
Mom.
All right. Well, anyway, so that's enough for being thankful.
Well, that's what you do in the holidays.
I know you do. Well, hey, I think it's a lost art, right? Being kind to one another.
Yeah,
right?
yeah.
Nowadays, definitely.
Well, one of your favorite shows is Downton Abbey. Yours.
Oh, I do. I love Downton
Aren't
Abbey.
they manners and?
Well, they do, but then they're stabbing. But British people can stab you in the back in the most lovely way. If I lived in England,
yeah, it would be bright and two-faced. Is that where the character came from, Batman?
yeah, if I lived in England, I would never understand that they were being mean to me. They were my phone. It must have been the turkey saying,
Don't eat me.
No, well,
I-
we had plenty of turkey.
Well, I would love to see that new movie, Downton Abbey.
Oh, well, it's beautiful. It's wonderful.
Yeah.
I don't know if any of you guys that are listening have gone to see it, but it's definitely a chick flick. And the movie theater I went to, there was all women in there, and a couple of men that they had hogtied.
Well,
but it was absolutely great.
Well,
It's
that's
wonderful.
I asked Chris to go a while ago, and I'm not going. But
Well, I love it. Okay, but all right, so because several times a year, 4 or 5 times a year, we just answer your emails. This is one of those Saturdays when we're not going to take calls. We're going to talk in depth about some of the tax questions that people have sent in. And so this is Email Saturday, and next Saturday we'll be answering live phone calls. And remember, I don't know if you guys know it, but it's just like 30 days till the end, right? Till the end of 2019.
Dun, dun, dun.
And I will tell
pull
you,
out your
we have
cot?
some. Pardon me?
you're gonna pull out your cot. Your cot.
Oh, my cot, yes.
Yes.
And then on top of everything, if you're a small business owner, EG Tax has just teamed up with a great company, and you're paying your own health insurance, where we can save you thousands of dollars retroactive back to beginning of 2019 for the health insurance that you've paid. And this is not a gimmick. You know us. We're here to help you. If you're interested in that, just give us a call at our corporate headquarters or email us at our website at egtax.com, because the typical small business owner, this would be a small business owner, saves like $3,000 to $5,000 a year in income taxes. So this is pretty cool, because it's basically an employee benefit program for paying health insurance, which makes it deductible.
I don't mean to be tooting your horn, but one thing I've watched you do throughout your life is try to make wise decisions with money, because we pay a lot of taxes, and when you have an opportunity to try to remediate some of that, you should seize
interesting.
it.
When we met with this company that really is going to help to manage this account for small business owners, he was saying that there's money that we could make. And I said, I don't care about the money we make. If I help my clients, then I will make money. I mean, it's like help the people, and if I make some money, great. But if it's not something to help somebody, I'm not interested.
Right.
Are you Noah?
Am I Noah?
You built the ark.
Why?
And then all the animals came 2 by 2, and
Well, I don't think I'm probably
Had-
old.
had to have
I'm
the
almost
faith.
as old as Noah, though.
No.
Right?
Okay, want me to start off with a
Yes,
small
all
business
right, so-
question?
Yes, small business. question.
So Bill writes in, it says, Esther, I own a small company with no employees, just myself and my wife. We are thinking of doing a LLC. I know this is a smart thing for protection. What are your recommendations? We went to a seminar not so long ago.
Right. Well, the whole thing is, if it's a single what's the word?
Owner.
It's not owner.
Entity.
It's
not a recognized.
not partner.
A single owner LLC. It's a
It's
An
uncoveted.
LLC has not shareholders, but an LLC
Members.
has members.
Ah,
Thank
there
you.
you
It's the
go.
word is members. If it's a single member LLC, then you potentially are going to get the protection that you want without having to file a partnership return.
Right.
But if it has more than one member and your wife is a member, then you have two members and you have to do a partnership return.
And you have to
which
do an
makes it far more restrictive because the rules for operating a partnership require, if you want the LLC to do the protection, you have to operate. You can't commingle the money. You have to have a separate bank account. So you want to make sure, Bill, that if you're doing the LLC, that you have a separate bank account. And if it's going to be two members, then you're going to have to do a partnership return. If you don't do the partnership return, then the penalty for doing the
covenant, the
partnership
seal.
return is a whole bunch of money every month.
Right.
What's the penalty? $235 a month or something
for not
for not doing a partnership.
$195 per shareholder.
And don't you have to
So,
write
per month.
Per
don't
month.
you have to write out either verbally
And
or
then you have to have an operating agreement
Right.
and all that stuff. So
and you can
what
break
I'd
that
suggest
seal.
you do, Mr. Bill, is give us a call at our corporate headquarters. Go to egtax.com and make an appointment. There's no charge before the end of the year, so we can help you. But an LLC is good because it does limit your liability. But in order for them not to pierce the veil, you have to act like a business. So it's
I
very
know.
important.
I know. Like, when I was teaching my class earlier in the month, I said, think of if it's raining outside in your regular partnership or your Schedule C, and you have no umbrella, you get wet. You get soaked. An LLC is your umbrella. It will protect you. I said, but if it hails, the umbrella can get shredded, and then you get wet again. So you have to make sure you operate the right way to keep that umbrella protected from the hail.
You got to open your umbrella.
You got to open.
You got to
You can't
operate.
just-
You have to use the umbrella the way it's supposed to be operated.
Correct. Right. Not in 60-mile-an-hour winds
Right.
like we had
Because
3
that's
weeks
the
ago.
trouble when you're a small business. Doing the bookkeeping can be a pain in the keister, and so sometimes business owners, many times, just don't want to do what you have to do. But if you want that protection, you have to follow the law.
And I would also recommend that Bill get insurance to protect his business. And there's a lot of different things. And you're so right about bookkeeping.
Right.
You're so right about bookkeeping.
Okay, and let's do quickly another.
Okay. Al writes in, I heard that alimony I pay to my ex is no longer deductible. Is that true? I pay her $50,000 a year, and I need that deduction come tax
It matters
time.
when the divorce
Is there
was
anything
finalized.
I can do?
It matters when the divorce was finalized.
Right, if it was a 2019 divorce, that would be correct.
Right. But
Or if it was modified in 2019, then the alimony is not taxable to her or deductible to you. But keep her out of court.
Be nice.
Keep her out of court so that it's taxable to her and deductible to you. And as long as it wasn't a 2019 court case, then you're going to be fine.
I
Right,
know.
and-
Sorry
Go
for
ahead.
stepping. I met with a client the other day, and they'd been going through this process of the divorce, and when she heard, she said, "I listened to your radio show, and when I heard this law, I was like, I picked up the phone to my lawyer, and we're like, we're going to finalize this." This was last year. She said, "We are going to finalize this because if she
You mean
wanted,
she pays the alimony?
Yeah, she pays the alimony.
Oh, good for her.
Yep.
Yeah, because you can have a great attorney who knows law, but tax law is something apart and different than many of the laws that attorneys are doing. So that's real important. And by the way, so if you're somebody who's paying alimony, you want to make sure that you don't go to court because if it's modified, it would make it not deductible. So that's real important. We're going to take I'm Esther Golias, the tax lady from EG Tax. Our website is egtax.com. We're going to take a short break. We'll be back on the other side. Hi, this is Esther Golias, the tax lady from EG Tax. Today is one of those Saturdays when we're just chewing up the emails. Again, we want to wish you belated happy Thanksgiving. I have Tiffany Fabian and Christopher Fabian here in studio with us. So we're not taking calls this week. We'll take calls next week, and we're just chewing up your emails. And if you have a question you'd like answered like this, just you can email us through our website at egtax.com.
And click on Ask the Tax
All right,
Lady.
what do we got?
I got Eddie, EG Tax. I drive a tractor trailer over the road, and my coworker said that we need to talk to our boss and tell him he should change us to contract labor instead of as an employee. I don't understand. Can you shed some light?
Okay, if you're an employee under tax reform and you incur expenses, job-related expenses, and being an over-the-road trucker is one of them, then the expenses for being out of town overnight that used to be deductible are no longer deductible. Now, if you become a contract employee, in other words, you're not an employee at all, you're self-employed, then those expenses would be deductible, but then you'd have to pay your own self-employment taxes, and it's not just easy to just say I want to become a contract employee, because if you're driving their truck, they tell you where to go, they tell you what to pick up, they tell you what we're going to pay you per hour, they buy the gas and everything. You can't just unilaterally become a contract employee. What you want to do is have your employer set you up on an accountable plan so you can get reimbursed for your expenses, which would then be not taxable.
That's a lot of stuff.
And you'd be made whole. Now, what happens in this situation, though, is if it's an accountable plan, it means your employer is shelling out money for your expenses, which would mean that the employer then is paying more for you to operate. So what your employer would want to do is kind of pull back on some of the wages in exchange for the accountable plan so that he's whole and you're whole.
So-
and that requires some planning.
Right.
Wow, that's a lot of planning. Go on, Chris.
So, like, say you get $100,000 a year pay. What Esther is saying is, and you normally spend $20,000 a year on your own expenses, cut your pay back to $80,000, get reimbursed for the $20,000,
Which is still 100,
which is still $100.
but the 20 won't be taxable.
The 20 is tax free, so you win. Then the 20 that the employer is reimbursing you is deductible to him. So he still has the $100,000
Right.
he's writing off.
He's happy and you're happy. Now, the trouble is, have you seen anybody
No.
that's changed?
No.
They
no.
still like are smoking dope in the
No.
corner. I mean, nobody's changed, and
No.
it's so stupid and it's so easy to do. So again, if you're an employee who isn't able to deduct your expenses and you think, oh, my employer will never let me do it, I'm going to tell you there's a way that they're whole, you're whole, and you both save income tax.
And then I got to tell you, I just sent 2 emails for businesses that are looking for us to do seminars. If you want us to come in and talk to your group about it, let us know. And then I also want to say, if you haven't made the change, if you're still on a non-accountable plan, don't forget that you can potentially deduct these expenses for job expenses on the New York return. And I find
Okay,
it's
so
really
let me linger on
advantageous.
that. So what Tiffany's saying, so you're on a non-accountable plan, so you're an over-the-road trucker. So on the federal, they say no dice, you can't deduct it. However, on New York State, even though it's not deductible on the federal, it still is deductible on New York State. Right, Tiff?
That's right. That's what I'm saying.
Okay.
And so you really want to tease that out and make sure that you take advantage. And lots of things that aren't deductible on the federal, such as the alimony, if it was finalized in 2019, is still on New York State. They retain the
Are
old
not
law.
deductible on the federal.
Yes, there you go.
Right. Okay, what else we got?
Well, let's go back. That goes but true for the alimony.
Alimony, too. If you did get a divorce in 2019 and you're paying or receiving alimony, it's not deductible or taxable. However, on New York State, it would be.
Yep.
Both deductible and taxable if you're receiving it.
Okay, I got tax lady. I don't have any medical insurance. I am 35 years old and only working part-time jobs because I went to school, but I still support myself. Isn't it true I won't have a penalty? Janie from West Seneca.
Okay, it is true. There's no penalty anymore if you don't have health insurance. So that's the good thing. Mm-hmm. The bad thing is you don't have health insurance.
Right.
Right? Now, I'm assuming if he lives in West Seneca, Janie, or it's a lady, if you live in West Seneca, that you're a New York State resident. Now, New York State has a very liberal New York State of Health, And the sad thing is, probably, Janie, if you don't realize it, you may qualify for almost free or totally free health insurance. So this is one of those situations where ignorance is not bliss, because ignorance means that you're not availing yourself of things that are deductible that New York State offers. And so what I'd suggest you do is call our department at EG Tax called EG Health Connect.
Yeah.
Tim Eliason is our director and president of EG Health Connect, and he can give you all the ins, ands, and buts and ors, and you may qualify
For something.
for absolutely free health insurance.
Or the essential
Or
plan.
the essential plan, which is $20 a month.
Right.
Yeah.
So where you think, ha ha, government, I'm not going to pay any penalty this year, so I'm not going to get health insurance. You could be giving up free health insurance.
Right,
Yeah.
absolutely. And that's, you really want to make sure that you're sure that you can't get the health insurance before you have no health insurance, because it's interesting. I was just talking to somebody a couple months ago, a lady that I know that didn't have health insurance, and I said, "You need health insurance," and she says, "I'm young. I don't think I'm going to get sick." Well, don't you know, she had a heart attack. But I had talked her into getting health insurance because she didn't realize it, but because she wasn't working, she got a large subsidy, and so thank God she had the health insurance.
Yep.
Hey, we don't know when we're going to hit by a lightning, get by a car.
I still remember our long time ago, Barry, who
Oh my God!
we
yeah.
said, you got to get your health. He came to work for us. Sign up for health. Oh, I'm going to sign up.
in his
I'm going to
20s.
sign up. And he got in a terrible car accident, was on life support for like 3 weeks.
that's
Couldn't,
right.
It
It was Super Bowl Sunday,
Super Bowl Sunday. And we're talking, what was that? About $1 million?
and he was 20 years old. You know,
I just also want to say I have lots of clients who they're like a family of 4 and they barely are making it. I mean, they're making about middle of the road and they're paying all this amount for health insurance at their employer. What you can also do is peel off their kids and go on the Healthy New York for the kids, and then the mom and dad have their own health insurance, and that saved them about $300 a month.
the whole thing is, when you talk about health insurance, people kind of their eyes kind of glare over. I mean, all these commercials on TV are all health insurance, and nobody knows who to trust, right? But I can tell you, EG Health Connect does not charge you, and as ethical as anybody can be, I mean, Tim is really ethically. It's our honor to be able to help you with your health insurance. So again, if you don't think you qualify, if you don't have health insurance, if you think you can't afford it, whatever, you want to get a second opinion. And I will tell you, if you've lost your job and you're on a COBRA plan, oh my gosh, you really
Use
want
the
to talk
marketplace.
to, you want to go to the New York State of Health, because there are all kinds of, I'm going to say it's a free benefit. Obviously, nothing is free. Somebody's paying it for you. But to you, there'd be no cost in many situations.
What were you going to say?
I was going to say, the penalty's gone. The reconciliation is still there if you do get a subsidy through New York State.
Right.
So the 1095A,
8965 on Form 8965.
right, you still need to reconcile your
Here's this
income.
Carl from Cheektowaga. This one. It says, I've been working at a large company but got fired in March. Before I was let go, I had a salary of $40,000 per year, and they paid for my health insurance. But since March, I haven't been successful finding a new job, so I've had a subsidy for my health insurance of $500 a month. Then in October, I got a new position making $50,000 per year, but they won't pay the health insurance until January. Is this something I need to be concerned with? Hello, this is
he's-
exactly what you're talking about.
You have to
I'm
go.
still on the New York State of Health with full subsidy.
He has to go back onto the marketplace. He has to enter his new income so that they modify and adjust his subsidy, or else at the end of the year he's going to be paying the
Right.
piper
So
then.
talk about the reconciliation. What do you mean by reconciliation?
So,
Donna.
yep. So say your insurance would cost you $1,000 a month, but based upon the income you tell New York State, they say we're going to give you $600 a month.
Or like in this case, 500.
Right.
Right.
So he would have to come up with $500 out of his pocket. New York State is contributing $500 to equal the $1,000. So then, when you do your tax return, we take that 1095A you get in the mail, and we look at your income,
And we say, oh, you made more money than you
Yep,
told them.
You told New York State you were only going to make $30,000 this year. That's why they were giving you $500. But in essence, you made $40,000, so you're only entitled to $250 a month. So then they're going to, the federal government's going to say, okay, well, that extra $250 a month times 12 months
Is additional taxes.
is an additional tax. So you have to come up with $3,000 on your tax return to pay us.
Right. And that's called a reconciliation. So if you have health insurance with a subsidy and your financial situation has changed, and it feels so good to say, oh my gosh, my subsidy's $500, and so I'm only paying $10 a month. That's great until it's tax time and you got to do the reconciliation and you find out that, you really shouldn't have gotten a $500 subsidy. You should have gotten a $50 subsidy, and you got to pay back the $450.
I have seen some of the angriest clients at the end of the year fall into this situation, and you don't want to have it happen to you.
Yeah, I've seen someone have to pay back $13,000.
You don't want
Oh
to have
my
it.
gosh. Oh my gosh.
Yep. So
Okay, I'm Esther Golias, the tax lady from EG Tax. If during the week you need any help, you can come to our corporate headquarters at 1890 Colvin. Our website is egtax.com. We'll be back next Saturday with live phone calls. We're just chewing up the emails this week. Right now, we're going to take a break for the news, and we'll be back on the other side. Hi, this is Esther Golias, the tax lady from EG Tax. This is Ask the Tax Lady. We're wishing you a belated happy Thanksgiving. We have so much to be thankful for in this country. Mostly we're thankful for God. We're thankful for you. We're thankful for being able to have good health. And I wish everybody wasn't mad at each other. Aside from that, anyway, but we're this week, this time of year, every once in a while we just do the emails. So we're doing emails today. We're not taking live phone calls. We will next Saturday. But I have Tiffany Fabian, Christopher Fabian in studio with me, and we're doing your emails. So what do we got?
Esther, my father passed away in May of 18. After over a year of cleaning out his house, I found some stock certificates. I know that I have to split them between me and my sister. The question is, I have no idea when my dad bought them. What do we do before we cash them in? I want to do the right thing. Holly.
Holly should be pretty happy, don't you think, Chris? Tiff?
yeah.
Yeah, absolutely. She should be happy. Now,
I mean,
it would have
I'm
been
assuming-
better if she would have, if Dad would have taken your advice and gone to our website. What is that thing that Tim has on our website?
Oh, the pre-planning.
The pre-planning thing.
We have on our website. I'm not macabre or anything, but on our website you can download this
Letter of intent.
and you basically, it goes through all of your things, like where's my stuff and where is this and where's my bank account, and you put it in your safe or leave it with your attorney, and upon your death, there it is, all laid out.
Yeah.
But Holly found the stock certificates, and I'm assuming that she was the executor of the estate.
So she
so
did a
she
stepped
now
up
has
basis.
Dad's stock,
Yeah.
which means that since it wasn't gifted to her prior to his death, she gets an adjusted basis.
Which is
right?
very easy. It goes to May of 2018. So that sounds pretty easy.
So you basically go to Big Charts.
Go to Big Charts or Google Finance, type in the stock name, historical prices, and it will tell you. And you want the closing price of that day, and that will give you your cost basis.
Right, and that's so if it said it was worth $100 a share, and you have 100 shares, then you sell it for 102, you have a $2 per share gain.
Well,
Now,
hopefully
the
it was
divi-
Apple stock that he bought when they opened.
Well, that's what I was going to say. Last year, when she filed his return, she didn't know it was there. And so the dividends that stock earned would have been taxable to Dad on his last year's return. And so depending on what the stock will dictate what the dividends earned were. if it was enough.
If it was a dividend
Yeah, but
earning.
Yeah.
but maybe he didn't have
have
enough
to file.
income to file.
Which- Yeah.
So-
Could have been then, though, a 1041 needed to be
Right.
done, too. So that could have opened up a little can of
which
worms.
is a
but
fiduciary return for a
Right.
decedent.
Right.
Okay, so yes, so
Good
so
news.
Holly, good news.
And then when you sell his house, also,
Good
you
news.
get good news too. You get the
assuming
stepped
that
up.
it wasn't in her name.
Right. Now, if he had gifted the house to you prior to his
Horse of a different color.
horse of a different color.
Okay, what else we got? Kids.
Louis writes in, Esther,
Louis.
I have 3 rental properties, and one of my friends told me I get this thing called QBI. What is that, and do I qualify?
Okay. I can't say if Louis qualifies.
Well, first, what is
This little
QBI?
bit.
That's a qualified business deduction.
Right, qualified business income deduction.
Right.
The 20% pass through.
Yep, which is really exciting.
So
A lot of
in order
times.
to do that, first of all, the rental properties have to be considered business, right?
Right.
Correct.
And that means he spent how many hours a year working on it?
250.
50, right. So that's number two. Number one, number two. Number three, they have to be handled in a business-like manner. So if Louis just kind of going over stuffing money in his pockets, kind of helter-skelter keeping
Separate
track of the
accounts.
books, kind of keeping some expense, not really acting like a business, it really wouldn't qualify for a QBI deduction. And number three, let's say that these rental properties are throwing a loss because of depreciation.
Right?
So once you have them set up and you make that election that you're going to treat them as QBI, if they were something that you were going to treat as QBI, they have to be on the next year, until the property's liquidated or sold.
Yep, and you
So
have to
that
keep,
means that those losses then, if there's losses, are going to negatively affect any other QBI deductions that you'd have.
That's
so
right.
you want to be very careful about deciding what you want to use as a QBI pass-through.
And then in order to denote that it is a business, another thing you have to do is you have to do separate bank accounts. You can't commingle your personal with your business. You have to have 2 different separate accounts.
Right.
Right.
And
But the whole thing with QBI, now they're coming up with a lot more regulations. Many of the businesses you might not want to classify as QBI because once the election is made, that if there were a loss, it has to carry forward to next year, and to the next year, and to the next year. So you want to make sure. Now, the first year that they did it, 2018, wasn't it 18?
Yep.
Yep.
That they said, the first year was like, we're going to let you erase a blackboard if you made a mistake.
Right.
But going forward, they won't. So you have to be very careful. So, and if you do have questions about QBI, you can call us at EG Tax,
Yep.
right?
Right. And this
on.
goes through for the self-employed people.
That's where I was gonna go.
Partnerships, S corporations qualify for the QBI too. And depending on your income, there is one of those major mathematical equations you have to do to calculate out your QBI based upon your wages you paid, your purchase of depreciable items. They don't care about what your basis is on your tax return. And then you could make another election to lump 3 or 4 businesses in together to make that better for this year as well. But like Esther said, once you make an election, that election is set for life.
I mean, it's tighter than if you got married.
Except if you want
could
to
get a
add
divorce.
to it. You can add to that election. You just can't take
Subtract
away.
from it, right.
It's unbelievable.
Yeah, but the
Okay.
QBI is something in your toolbox, and you certainly want to.
Well, and obviously, the pass-through deduction, 20%, is really important. The pass-through is for anything other than an 1120 because a corporation has a flat rate of 21%. Now, we've talked about this before. If you have a lower net profit on your corporation, it used to be that the corporation taxes were graduated, but it's no longer graduated. You're paying 21% flat rate. All right? So if let's say your net profit is only $30,000 or $40,000 on your corporation, you don't want to be an 1120. You want to be an 1120S, and that requires planning. So you want to make sure you talk to if you're a lower net profit or negative net profit corporation, talk to your accountant because there should be some adjustments made.
That's right. I've got Barbara and Jim. EG Tax, with the windstorm we had on Halloween recently, we had a lot of damage from trees falling on our property, from the house to garage to the fence. Insurance is going to pay for about half, leaving us with about $45,000 we have to come up with on our own. How do we claim this on our taxes? Well, the truth
only
is
on New York State can you get anything.
Yeah, it has to be a
unless
national
it has
disaster.
to be a federally declared disaster in order to take a casualty loss on the federal. On New York State, however, you will qualify for a casualty loss. But I will tell you, you better document. And really now this is the end of November. We are now a month past the event. So if you didn't take good pictures and you don't have good proof of the loss, then New York State, I'm sure, will spend some time auditing you.
Right. Well, I'm sure if you're going through insurance, they'll have that, what all the damage
that's
was.
true. That's
But
true.
if you didn't go through insurance, first of
You
all,
have to.
You have to go through insurance in order to claim the casualty form on New York State. So you're out of there, and wasn't that much damage where it was declared a federal disaster
Not at all.
area to get it on
I mean,
the federal.
they must have really had some bad luck because there really wasn't that much.
No, I know there was some power outages and things like that, but if you had some old pine trees, maybe if you lived in the country and they fell down, who knows?
Right.
That's true. That's
Right.
true.
But
But
it-
unfortunately, it can be deemed that you were neglectful with your property,
Yep.
because they would say, well, if you neglected, maybe you say, well, that pine tree was in tough shape. Then they'll say, well, then why didn't you cut it down?
Right.
Right.
Yep. And so this goes back to the fact that New York State retained the old law, whereas the federal has the
That's
tax
correct.
reform.
That's correct. All right. What else we got?
My mother, Jody, writes, Esther, my mother just hit a jackpot in the casino of $15,000. She said she doesn't have enough to pay tax on it because she loses to cover it. First, can this be true? Second, how do I get her to stop gambling? Yeah. So $15,000 if she's single.
Well, let's say all mom had was Social Security, and let's say her Social Security is $18,000, right?
Right.
So now she's got the
Plus the
$15,000 from the gambling, so that she's got $33,000. So her floor is 25, so she's got 8,000. So 4,000 of her gambling would be taxable. She won't pay any taxes on that.
Right.
Well,
Because she's over the age of 65, she gets a higher standard deduction.
Her deduction
Right.
is 13,600.
Yeah.
Right.
So if her
4,000 of her Social
Right,
Security is
right,
going to
yep.
be taxable, right?
Right.
Yep.
So, and the 15
On the federal, she
on
won't
the
pay.
right,
On the federal, she's going to be okay.
but on the state,
She's gonna owe still.
Yeah, and she can write off her losses on the itemized deduction.
no, she's going to have 4 plus 15. She'll have 19,000. She will owe a little bit on the federal,
Yeah.
right? 4,000 of the Social Security is going to be taxable,
Right.
plus
So
the 15,000. So she
yeah,
will have a little obligation on the federal, because the gambling losses, it's true, is a deduction on the federal. Okay. So she'll have that 15,000 that comes off for that's
Yeah.
true. She won't. She
She-
won't owe anything.
No, 19 minus
No, she'll
5,
have
$400.
$400. She'll have a $400
she'll have
liability.
about- yeah.
She'll have a $400
And
liability on
then
the federal.
just to throw a monkey in
But
the wrench.
but
if
the worst thing is, when seniors are gambling and that have Social Security, they don't realize that they're going to make 85% of their Social Security potentially taxable. So you have to really, when you're going to the casino, it can be really, really expensive. Not just losing
And then
money,
I
it can
wanna
cost you money
say
in
something.
taxes.
Don't forget, on the itemized deduction, she can also write off her sales tax, her charity, possibly her health insurance. So she's really, I mean, if she's a single person, there's a great opportunity that she might be
Well,
itemizing.
She might be able to itemize. That's
Right.
true. So the worst case scenario is $400 in the federal.
Right.
Right. And for her, there's really no other thing to worry about. But for others who have a pension or other income, it could cost them on their enhanced star. It could
that's
cost
true.
them on their health insurance
true.
through Social Security. There's a lot of other factors that
true,
going
true.
into that.
And then, secondly, it says, how do you get her to stop going?
Well, I mean, I guess when she gets her
Heart
tax
to
bill,
heart.
she'll
Yeah.
know, right?
Yeah, yeah.
I'm Esther Galias, the tax lady from EG Tax. We're joined in studio with Tiffany Fabian, Christopher Fabian, wishing you a belated happy Thanksgiving. We're going to take a short break. We'll be back on the other side. Hi, I'm Esther Galias, the tax lady from EG Tax. I'm joined in studio with Tiffany Fabian, Christopher Fabian. We're wishing you a belated happy Thanksgiving, and we're chewing up emails today. And again, if you want your email answered, you can go to our website at egtax.com and enter it, and we might feature you on one of these conundrum Saturdays. Next week, we'll be back with live phone-ins. All right, what else we got?
I've got Margaret, tax lady. What should my husband and I look for? He's retired on a New York State pension of nearly $45,000 a year. We both get Social Security of $2,000 apiece, and we have some investments which we've done pretty good. My husband is 72. I'm 69. Presently, we own a home in Lancaster, but we're thinking of downsizing. Or should we just give our home to our daughter? We're just trying to plan. Thank you for your information.
Well, first of all, I think Margaret needs to come in and talk to us. There's no
Right.
charge for the consultation.
Right.
It was interesting in her little email, she doesn't mention her RMD.
Right. Right.
So if your husband, Margaret, has an IRA or an annuity
A 401k.
or a 401k that he hasn't been taking, once you're age 70 and a half, you have to do a required minimum distribution. So
point.
I'm hoping that he had done that in the past, because once he was 70 and a half, which would have been last year, I'm assuming, he had to start taking money out. Now, if he didn't, the penalty for failure to withdraw the money would have been 50% of what he didn't take out. So if he was supposed to take out $30,000, they're going to give him a $15,000 penalty.
Right.
Now, you can ask
For forgiveness.
you can ask like for a mea culpa, please forgive me, I didn't know, and most of the time they do let it go.
Yeah, they do.
So there's an exception to penalty form, but you got to make sure that you catch up and take that money out. So that would be the first thing. Secondly, you're 69, you're approaching your 70, once you're 70 and a half, you have the same
thing
problem. So you got to make sure that you plan that. Gifting your house, what do you think about gifting the house?
No, put it in a life estate.
Yeah, I mean, that's where it comes to planning. Right now you're going to downsize, or you're staying in Lancaster. What if your daughter moves to North Carolina? Are you going to move to North Carolina with her in 5 years, 6 years? Is this going to be your home you're going to stay in the rest of your life? Because if you gift it to her or even put it in a life estate, which is a possibility, and you sell that house when you're alive, your daughter gets your basis in the house, not a stepped-up basis, but gets your basis. So,
Original basis.
Yep.
Right?
So it could end up costing your daughter a lot of money.
All right, so let's back up. So if you gift it to her, all right, while you're alive and obviously alive, then what you and your husband paid for the house, how many years ago, plus the improvements, that's what if she sold the house, is what would be what she paid for it. So if you paid $100,000 and it's now worth $250,000 and you gift it to her, then she's going to say when she sells it that she has the difference between $250,000 and $100,000, which is $150,000 taxable gain. If you put it in a life estate, right? Mm-hmm. And you pass away, then the fair market value at the date of your death becomes her basis. So if it was worth $250,000 when you passed away and she sells it for $250,000, there's no gain.
Right.
So you really want a life estate would be the least I would think you'd want to do.
Right.
But you wouldn't want to just go ahead and gift it outright, because it could cost the person upon your death a lot of money.
Hey, and then Esther and Chris, don't forget they have lots of investments. Don't forget to put beneficiaries on those investments.
Oh, that's very
Because I
true.
can't tell you how many people don't put beneficiaries, and then it goes to probate, and then New York State gets their hands on it, and it takes longer, and it just muddies the water. There's tax
That's right.
consequences.
And I will tell
potentially.
you, many times you think about why would you want to do a revocable trust, right? Because in a revocable trust, even though it can be it does, it's still taxed on your tax return the same. It avoids probate.
Okay.
So a revocable trust is something maybe that they'd want to do on this situation
Right,
too.
and looking at this again, if she's trying to do tax planning, the good news is, which I'm sure she should know, hopefully, is that there's no New York state tax, depending on her investments or her 401k and IRA, because the New York pension is totally tax-free, and the
Right,
Social Security is tax-free on New York State. The only one you got to worry about is the federal, and that's where we should sit down with you to go over all your figures to make sure your
Right.
withholdings
But
is
Margaret, I think you and your husband are due for a
tune-up?
a tax tune-up.
And then,
Yeah.
hey, another little caveat. What if they go to Florida and they have a New York State pension? Do they have to worry about paying tax on that New York State pension?
There
that's
are no taxes in Florida.
That's right. But we don't know where they're going.
It was interesting. I read an article the other day that the top 15 markets in the United States with the largest growth, like 9 of the 15 are in Florida.
Wow.
Isn't that something?
Wow.
Wonder why that is. Okay, what else we got?
I got another one. Alice writes in, I am on long-term disability and just finally got approved for Social Security disability. But they say I have to pay it back to the disability company. Do I still have to pay tax on the Social Security? Also, the disability company wants to offer me a one-time settlement of $110,000. Should I take it?
Okay.
Well, that is a lot of stuff. That is a lot of stuff. And that is so true. And under the old law, there used to be, you could write this off on the Schedule A at the bottom, subject to 2% on the itemized deduction. That is gone on the federal.
That part is, you still can do a credit.
You can do the credit for what the taxes should have been.
Right.
Right.
Which is exactly what you do. What is that, a 112?
Oh, boy.
You shed light on this, Esther. You.
I can't remember the
But there
name
is
of
a
the
technical
credit,
term.
but
There's a
whatever
form-
the,
yeah, you-
the tax liability should have been prior to the taxability, you would get a credit as if it's withholding on page 2. Well, it isn't page 2 anymore.
Right.
I don't even know
But
what form
unfortunately, because you get it on page 2, 85% of the Social Security is still
taxable.
going to count
Right.
as income.
Right.
And I would say in regards to the buyout, the settlement offer, you got to look at it. How many more years do they have to pay you?
Right.
Versus
It comes down to a mathematical equation. You have to put pen to the paper, and you have to realize that once you take the 110,000, I know 110 sounds like a lot of money, but the truth is it's really
after
not.
taxes, in your situation, you could be looking at only coming up with 70.
And again, if you need any help, just give EG Tax a call. You go to our website, and we'll make an appointment. There's no charge.
Yeah, and then also, do I have to pay tax on the Social Security? So if that
It could be a lump sum election.
It could be a lump sum election also.
So
Yeah.
a lump sum election is a way of kind of, remember the old income averaging where you'd go back? With
Yeah.
the lump sum election kind of goes back to the way it originally was as well.
Yeah, and Al, you ask a really, really good question, and that that ties into tax reform. With tax reform, Chris and Esther, you've got to agree with me. There's been so many changes and so many ebbs and
gosh.
flows, and there's
Well,
really
and the thing is, it's so complicated.
Yeah.
It was interesting. We went to a seminar not long ago, and they called it simplification. This is the most confusing
Oh, my God.
can of worms.
Esther, you should see me teaching the tax class, the basic tax class. I say to people, oh, you used to just go to the 8863 to do the college credit. Now we got to go to Schedule 3. Then we got to go to 8863. I just shake my head.
Yeah.
I just shake
Well,
my
of course, the Schedule 3, that's kind of, some of it's being modified. They're changing it again, see?
Yes. They're changing
Gotta
it again.
love it.
Yeah.
Yeah.
Okay, what do we got here?
I've got Clarence from Jeff from Clarence, excuse me. EG Tax, I own 8 rental houses in the University District. I bought them about 20 years ago for under $100,000 a piece, and now they're about to double. They have doubled. I'm so tempted to sell and take the profits. What do you think?
Well, I mean, I can't say that I disagree with Jeff. There's no time like the present for, if you know you're going to make money, there's nothing wrong with taking some profits. How you take the profits is the important thing, right?
Right.
Because he can get out of these properties by doing an exchange,
Right.
tax-free exchange.
Right, which is basically trading your properties for another property.
Right.
It doesn't have to be with the same owner of, you're not doing
And
a
there's
trade
a
like
lot
that. It's
of liquid. I mean, it's a pretty liquid thing. You can. The most important thing is understand that you can do a tax-free
You could
exchange. So you
exchange
can
it
take
for commercial property.
these 8 properties and exchange it for one commercial property that you're a limited partner in, for
Right.
instance.
Yep.
So you can sit home, clip coupons, and really enjoy retirement if that's what you're looking.
Because let's
at
face
doing.
it, managing 8 rentals is much more difficult than being a partner in a plaza.
Like for instance, I know Family Dollar is doing a lot of
Yep.
limited partnerships.
Yep. How about
So you can get out from under. Now, the only problem is that you said you want to take the profits. If you do an exchange, you can't take the profits. The profits are rolled into the new property.
Yep.
So
Otherwise, he's
Otherwise-
looking almost 100% gain on all of them.
right,
There's
and
very
that would
little
be really
basis
bad.
left.
So you're talking about maybe $2 million worth of property. It would be a very sad thing,
Yep.
especially on New York State because they have no benefit.
Come in, run the numbers,
Yep.
and it will open your eyes.
Yep.
Now, yeah.
And make you cry like an onion.
And I'm sorry, Tiff. One thing too is he could take the properties, exchange them. Say if he's thinking of retiring, buy a house in Florida, since
And
that's
rent
where
it out.
everybody's going. Rent it for 2 years,
Right, and then
move into it.
Right.
and he still won't pay
Very
tax on
good
the
point,
gain.
Chris.
And
Very
that
good
is true.
point.
I mean, I don't know if you got this, but there
Planning.
are a lot of things you can do if you know to do it, and EG Tax is there to help you to do it. If you need us during the week, we're at egtax.com, 1890 Colvin. You can email us, call us. We help you. We want to help you. And this being Thanksgiving, we're saying thank you for being such great clients. We appreciate it. We love you. Have a great week. Until next week, I'm Esther
God
Julius, the
bless.
Tax Lady, with Tiffany Fabian and Christopher Fabian. Bye-bye.